Hi guys, Joshua Tharby here, Managing Director, Award-winning Chartered Tax Advisor. Welcome back to my YouTube channel. Today we're talking all about what taxes apply when selling a property, how you can avoid them. So I've had a lot of people asking about covering this topic on the YouTube channel because it's something people really want to know about at the end of the day. Us landlords, we don't tend to sell our properties, but when we do, we want to keep as much of the cash as possible, understandably, and we don't want to give any to the taxman. So today, that's what we're going to be talking about. We're going to run through essentially what taxes do apply, whether you're an individual or a limited company. Because first off, we need to know what we're up against, don't we? Know your enemy. And the same is true here. We need to know exactly what taxes apply. And I'm going to give you some tips and tricks on how to potentially avoid them, or at the very least, make sure they're the smallest and minimal amount possible. So let's get started. So what taxes do apply when you sell your property? So as an individual, when you sell your property, you're going to pay capital gains tax. So as your property, you've got a capital gain. So if you buy a house for £100,000, you sell it for £200,000, keeping the numbers very simple, ignoring all the other costs which I'm going to run through, you've got a capital gain of £100,000. And on this, you'll pay capital gains tax. So what is the capital gains annual exempt amount? Well, it's similar to your personal allowance in that you can earn this amount completely tax-free. So say, for instance, to keep the numbers simple, if you had a capital gain of exactly £12,300, which is what the capital gains annual exempt amount is for this current tax year, then you wouldn't pay any capital gains on it whatsoever. Whether this capital gain came from shares, property, crypto, you wouldn't pay any tax on this whatsoever, and it's completely tax-free. So going back to that previous example where you're at a £100,000 capital gain, that's what we'd look at. You'll deduct your capital gains annual exempt amount, and then you'll pay tax on the rest. But you can deduct expenses from your sales proceeds when determining and when calculating that capital gain. So you remember you pay stamp duty when you purchase that property, that's deductible. Estate agents' fees, solicitors' fees, all of these costs are tax deductible and can come off of that £100,000 gain, which is going to reduce the amount that is taxable under the capital gains tax system. So you want as many expenses as possible to bring that down. It's also worth noting that if you do any improvements, such as you do an extension, you upgrade the kitchen, you do all of these upgrades, then as long as they're still reflected when it comes to selling the property, you can claim the cost of those as well. So you need to dig out all of those receipts, all those invoices to try and make sure you've got as much information to bring your capital gain down, because as a result, you're going to pay less tax. If you own a property in a joint name with your husband, wife, spouse or civil partner, if it's 50-50, then you'll both be taxed on 50% of the gain and you'll both benefit from having your own personal allowance, your capital gains and an exempt amount each. So a very savvy bit of tax planning here is if you do have a property owned in your full name and you are married, before selling it, look at transferring a small portion to your wife, because transfers between husbands and wives take place at no gain, no loss. You can actually transfer some of the property to them so that when it comes to selling it, you can use their capital gains and the exempt amount as well. So that's how we calculate the capital gain that's actually taxable. For property in the UK, capital gains are taxed at 18% and 28%. They're taxed at 18% where they fall in your basic rate tax band, and anything over and above that, they're taxed at a higher rate of 28%. If you've been using your property as serviced accommodation, however, you can actually claim business asset disposal relief, which means you pay tax at just 10%. So that's how capital gains tax works for individuals. For limited companies, it's similar but much more straightforward in that you don't have any of these individual rates such as 18 or 28%. It's literally just the corporation tax rate. You can deduct all of the same capital costs to bring it down, but you have no allowances. So going back to the example, if you've got £100,000 capital gain after deducting all of your costs, all of your allowable expenses, all the capital improvements, you're just paying 19% corporation tax on that currently, which means you've got £19,000 gain to pay. So if you are going to do a lot of capital disposals, this might indicate that you're better off in your own name. Certainly when deciding whether to be in a limited company or your own name, if you are going to sell some properties every couple of years, the availability of the capital gains and an exempt amount is certainly not worth overlooking, because it is very valuable in some cases. Just a presence on a normal disposal, using your capital gains and an exempt amount might actually save you about £2,500 in tax. So it's very, very valuable. So that's what taxes apply when selling a property. Now, what are the options to avoid these or certainly reduce them? So the first one is basically to live in the property. Primary residence relief is a massively valuable relief, and what it does is where you live in the property, it completely voids that period of ownership from being taxable. So say for instance, if you've got a gain of £100,000, you've lived in the property for all of the time you've owned it, and if that's been your main residence, you won't have any capital gains tax to pay whatsoever. It's fully tax-free. So a fantastic way to build serious wealth is to buy a property, kind of do it up, add value, live in it as your home for a couple of years, and keep upgrading as you add more value, as you get more equity in the property. And you can do this tax-free and work your way up to a massive £1 million home without paying a penny in tax. That's massively valuable, and primary residence relief certainly should be used as part of your tax planning strategy when it comes to accumulating wealth. Another way is to make small disposals, so you use your annual allowance, £12,300, you mentioned it earlier. So make sure if you are selling a property, you are using your spouse, civil partner's annual allowance. If you're buying a property and you think you might sell it in a couple of years' time when you've got capital depreciation, have you used your adult children's capital allowance? If you are going to bring your family members in to your property business later on down the line and you want to use their allowances, if you've got adult children that are at university and you want them to benefit from this, having them as owners of the properties as well is going to give you access to their capital gains annual exempt amount later on. Of course, they have to share the proceeds, but it's a great way of getting funds out of your estate and out of your estate for inheritance tax purposes. So if you are looking to start transferring wealth to the next generation, it's a very capital gains efficient way of doing it, as well as saving IHT. Another one we briefly touched on earlier was using the property as serviced accommodation. So when you sell the property currently, if you're using it as a normal buy-to-let, it's 18 and 28%. But if you use it as serviced accommodation, then you actually, for the full period of ownership, will still only pay 10% capital gain on the end value. Even if you used it, say, 8 years as buy-to-let, used it for 5 years as serviced accommodation, that full gain would only be taxable at 10%. So there's a massive saving available there. Of course, you need to make sure the property works as actual service accommodation and your lender allows it, make sure there's a demand, make sure you've got the right insurance products. There's a lot more to it, but if it's an option, it's certainly worth exploring and can save you some tax in the long run. Also, it's worth noting that if you use your property as service accommodation, Section 24 does not apply. So a lot of people are aware of Section 24 and the finance costs being restricted. If you use it as service accommodation, that doesn't apply. All of your interest costs are still fully tax deductible. And last but not least is refinance the properties. So if you don't sell the properties, there's no capital gains tax to pay. So property prices keep going up and up and up. And what you can do is, if you do want the cash from some of them and you've not got any mortgages or you've got a lot of equity in them, refinance, pull the money out, and then you can use that for other things without actually having to sell the property. And then because if you don't sell the property, there's no tax to pay. When you die, there's no capital gains tax to pay. So if you basically give all of your property to the next generation, you'll pay inheritance tax at 40%, but there's no capital gains tax to pay there. So if you do only have a small amount of wealth that falls into your nil rate band, this can be a very tax efficient way of doing it. Alternatively, if you leave everything to your spouse, they'll benefit from the capital gains uplift. So they won't pay any capital gains. They'll inherit all of your assets at the market value, and then the surviving spouse can potentially give them on to the future generation without any capital gains tax to pay, providing they live 7 years. It's an absolutely tax efficient way of moving things around. So there we have it, folks. These are the taxes that apply when selling your properties. I've given you some fantastic pointers on ways to avoid these taxes, or certainly make them as low as possible. If you found this video useful, please do smash that like button, because it helps YouTube know that this video is good stuff and helps it spread across the property investment world to make sure other landlords and property investors are benefiting from this fantastic content. Also, if you've got friends, family, colleagues, business partners who are going to benefit from this and have properties that they're selling and want to pay less tax, please do share this with them so that as many people can benefit from this as possible. Most importantly, if you'd like to see more of this fantastic content, then make sure you do hit that subscribe button so you get notified as soon as we post more videos and you do not miss out. Each week we're going to be posting 3 videos per week of fantastic brand new tax saving content aimed at giving you more cash in your pocket and helping you grow a larger and more profitable property business. That's all for today's episode, but again, please do make sure you like, comment and subscribe if you found this video useful. Have a great day. Bye for now.